What's good, YouTube? Welcome back to my YouTube channel. Today we'll be talking about a very important topic. And if you're seeing me for the first time, my name is Smart Money Rich. I am a Forex trader, a mentor, and a coach. So guys, without further ado, today I'll be explaining what inflation is. The topic for today is going to be inflation. We'll be talking about inflation and how you as a currency trader or as a financial market trader can actually profit from inflation. When we talk about inflation, just put it at the back of your mind that we are talking about the consumer price index, which is the CPI, and the CPI tracks the changes in prices of goods and services. That's what we'll be talking about today, and we'll also be talking about the central banks and how they measure inflation to make their economy work well. Actually, the last thing is going to be how to trade and profit from inflation. So make sure you watch this video to the end. And if this is a topic that you've been curious about, this is a topic that you actually wanted to learn about, make sure to click the like button, subscribe, and turn on the notification bell. Let's go straight into the topic, guys. Let's talk about inflation and how you can profit from it. Let's go. YouTube, hope you guys are doing good today. So I'll be explaining what inflation actually is and how you can profit from inflation, guys. So what is inflation and why should traders actually care about inflation? Now when we talk about inflation, we are simply talking about when a country is experiencing, let's just call it hardship. You understand? So inflation is the rise in the price of goods and services. So now inflation simply means when the prices of goods are skyrocketing in a particular country beyond how it should be. So let's say, for example, you used to buy a loaf of bread for $1, and now when you go to the stores to buy a loaf of bread, you're now buying that loaf of bread for $5 instead of $1. In that same country, let's say you used to pay your monthly rent at $200 per month, and now the price of house is costing over $400 per month. This simply means that that country is experiencing what we call inflation, because the prices of goods and services is skyrocketing out of hand, and the central banks need to step in and make some amendment before the country experiences what we call recession. So inflation simply means the loss of fiat purchasing power. So let me explain this to you. Now, when we say the loss of a fiat purchasing power, simply means when you have $1 million and you're not able to do enough with your money is no longer able to get you enough things as much as it's supposed to get you. It means that your purchasing power is dying. You have enough of money, but you can't do enough things with the amount of money that you simply have. So when inflation is rising, when the price of goods, of services is rising, is going up, fiat purchasing power is simply coming down. Do you understand? So if the price of one loaf of bread used to be $1 and the price of a loaf of bread now costs $5. Let's say, for example, if you used to be able to afford 5 loaves of bread for $5, now it will be costing you so much for you to be able to afford 5 loaves of bread, because the price of that loaf of bread have gone higher than it's supposed to be. So now when the prices of goods and services is skyrocketing like this, is actually not good for an economy, because this thing will actually lead to an economy to experience what we call recession, is time of decline, because this will cause the citizens not to spend money the way they were supposed to spend money. This will cause companies to start to sack their workers, and they will no longer increase salaries because of the inflation that the country is actually experiencing. Now, workers will be sacked, and workers will now be holding on to the little money they have, causing them not to spend money, and this is very, very bad for an economy. Imagine if you used to pay a rent for a month for $200, and now you're paying a month for $400. That's way too much for an individual living in that particular country, right? You can see the graph over here showing the fiat purchasing power declining while the price of goods and services is all going high. Now, when the price of goods and services is coming down, then the fiat purchasing power will continue to do what? To go up. Why should traders care? Traders should care because the central banks care, right? So central banks have a very strong interest in keeping inflation at 2% a year. Anything below 2%, let's say inflation at 1% is bad for an economy. Inflation above 3% is actually bad for an economy. So the central banks always make sure to intervene with monetary policy and maintain inflation around 2% a year. That's the interest. The actions central banks may take to accomplish this agenda can move the market. Now, if you see whenever the central bank's chairman comes out to cut or hike interest rate, you will see that the market is going to experience what we call high volatility. So you can actually make profit from these volatilities in the market, because the actions that the central banks take actually moves the market either up or down. It all depends. Okay. So now, guys, we'll be talking about the CPI, which is the Consumer Price Index. This is a way that the central banks tracks inflation. CPI tracks the changes in prices of goods and services in a particular country, or in every country, or in an economy. That's what we call the Consumer Price Index. So Consumer Price Index tracks the changes in prices of goods and services. That's what we call CPI. Let's say, for example, you used to buy a loaf of bread for $1 and you're now buying a loaf of bread for $5. There is a change in price on that goods. There is a change in price on that goods, and the central banks need to track it so that they can take measure concern about it. So it tracks a basket of goods and services. That's CPI. Yeah, CPI tracks a basket of goods and services and their price changes. Let's say, for example, let's talk about the CPI components. When we talk about the CPI components, we are talking about something like food and beverages. We are talking about energy, which is light. You understand? We are talking about housing, transportation, medical care, and recreation, etc. Right? These are the CPI components, and we have the core CPI. Now, the core CPI excludes food and beverages. It excludes energy, because foods and beverages, including energy, are very, very volatile. So core CPI simply focuses on housing, transportation, medical care, recreation, etc. So they are going to look into the prices of houses, the prices of transportation, the prices of medical care, the prices of recreation, and etc. Others and others. Now, this core CPI is where the central banks focuses on the most. You understand, guys? But we have the CPI, the normal CPI, which includes foods, beverages, and energy. But remember, the foods and beverages are very, very volatile. So the central banks mainly keeps their focus on housing, transportation, medical care, and recreation plus others. So what do I mean? When you're talking about inflation, you're as well talking about CPI, which is the Consumer Price Index. So let's talk about measuring inflation and inflation position. Now, when we talk about inflation, we have things like disinflation, we have the sweet spot, and we have the hot spot. Now, I'm going to tell you how to know when a country is actually doing very, very bad, when a country is okay, and when a country is doing absolutely bad. You understand, guys? So now let's talk about measuring inflation. It is the central banks that actually measures inflation using what we call CPI, which is the Consumer Price Index. When we look at Consumer Price Index at 1.5%, this is what we call disinflation, and it is not good for any country. It is not good for an economy. Now, it is actually bad for their currency. When we look at inflation around 1.5 to 3.5, like below, let me say inflation around 2% per year. That's the target of the central banks. That's the sweet spot. That's where they want inflation to be, around 2%. You understand? Anything within 2% is the sweet spot. That's actually good for the economy, and it's actually good for the currency. So if a country is experiencing disinflation, this is bad for the currency. When a country is experiencing a good inflation, which is the 2%, this is good for the currency. And when the inflation is at 3.5%, this is hot inflation. This one is very bad. It has gone out of hand. Now, high inflation can lead to runaway prices, which can hurt an economy. Low inflation shows economic recession and lack of demand or lack of growth. Low inflation simply means that an economy is experiencing recession or the economy is not growing, which is actually bad for an economy. High inflation, bad for an economy. Low inflation, bad for an economy. What is the sweet spot? Let's talk about the sweet spot. Inflation is idea. It allows growth without overheating. The Fed's goal is to keep moderate inflation with max employment. Okay? Now, let's look at how to trade inflation. How to trade inflation. So, we are going to be using the USD, which is the US dollar, for example. When an economy, or let's say when the US economy is experiencing disinflation, this is when we always see bullish gold and silver, stronger currencies and bonds. Then we are going to see stocks bearish, indices bearish, US dollar bearish. Disinflation is bad for the dollar. It causes the dollar to sell off. It causes the stocks to sell off. It causes the indices to sell off. This is the time gold will be buying. This is the time silver will be buying. This is the time other currencies trading against the US dollar will be buying, right? So let's talk about the number 2, which is the sweet spot within the 1.8% or the 3.4%, or you call it the 2%. This is the sweet spot. When the US economy is experiencing the sweet spot, which is the 2%, let's just call it the 2% inflation, it's actually bullish for the stocks. It's actually bullish for indices. It's actually bullish for non-USD currencies and bonds. Then the US dollar is bearish. Gold is also what? Bearish. All right, guys. So let's talk about hot inflation. Hot inflation is bullish for the USD, right? It's actually bullish for the US dollar. The stocks will sell off. Indices will sell off. Any currency pair that is trading against the US dollar is definitely going to sell off. The bonds are actually going to sell off. Okay, hot inflation, good for US dollar. That's when you see the dollar will become very, very bullish. Okay, hope you guys are enjoying this video. If you enjoyed this video, make sure to subscribe. All right, guys, so I know that this is what you guys have been waiting for. All this while I've been explaining CPI, and I think this is where it's going to be very, very interesting, because right here we are on the Forex Factory website, and this is the website that you come out to check economic data. You know, before the news is being released, everything will be posted here. So you see it's Friday, April 10. You know, you will have to see the dates that the news will be released. On the date side here, you see we have Friday, April 10. We have Saturday, April 11, which there is no news. And there's no news on Sunday. There's no news on Monday. But on Tuesday, we have core PPI and PPI month over month. So let's simply talk about the CPI, which is the core CPI. If you remember, guys, I told you guys that the core CPI excludes food and energy because they are very volatile, and they focuses more on housing, transportation, medical, and all of that. So this is how you know when an economy or the CPI is going to buy or it's going to sell, right? So you see what we have here. First of all, you need to see that we have the details, we have the actual, we have the forecast, and we have the previous. So let's start from the previous. All right, guys, so let's start from the previous, right? So when we talk about the previous are the previous results. You know what a previous is. Let's use football for an example. If Manchester United and Chelsea are supposed to play a match this weekend, and you say you want to look at their previous result, it simply means you are looking at the previous matches that they've played and the results, the outcome of those games. So when we talk about the previous, it simply means the previous results of the CPI. And let's talk about the forecast. The forecast right here is the result that the top analysts are expecting the news to come out as, right? So you see we have the forecast here is the previous was 0.2%, but they are forecasting CPI to come out to be 0.3%. Who are these forecasters? These forecasters are all the top analysts from around all the big institutions like Goldman Sachs, like Bloomberg, like mention all the big institutions, all the big banks like Wells Fargo. They have their own financial analysts and people that looks into an economy for them. So these forecasters are like the top analysts that comes together and say, this is what we are expecting this news to be. We are expecting it to be positive, or we are expecting it to be negative, right? So the forecasters are expecting the news to come out better than the previous, right? So now if you look at the sources, right, you see the source here, Bureau of Labor Statistics, which is the latest release, right? Those are the people that comes out with the news. Then we have the measures. The measure of the CPI, change in the price of goods and services purchased by consumers, excluding food and energy. Usual effect, actual greater than forecast is good for the currency. So what is the forecaster saying here when they forecasted the result to be 0.3% while the previous was 0.2%? It means they are forecasting that this month's CPI, Consumer Price Index, is going to be better than the previous result, because actual is greater than forecast, which is actually good for the US dollar or for the economy you are looking into. Like the frequency released monthly about 11 days after the month ends. You understand? So we are currently in April right now. By May 12th, that's when the next CPI news will be coming out. So why traders care? Consumer prices account for a majority of overall inflation. Inflation is important to currency valuation because rising prices lead to central bank to raise interest rates out of respect for their inflation containment mandate. So you have to check when you're checking at Forex Factory, you have to make sure you go through all of these things so that you understand what you are doing. Now you see the actual. The actual is going to be the latest results. But right now, you see, we don't have any actual. The news is not out yet. So what does this mean? This means if you see that the forecasters are expecting this news to be positive, one way or the other, it might be positive, and there is no possibility that it will actually be positive, but you need to know that these guys are very smart, they are very intelligent, and they understand economic more than every one of us. They are the top institutions. Before West Fargo will employ you to come and do this kind of job for them, it means that you might be correct one way or the other. Now let's look at the results, the previous, the actual. Now we are going to start right from June 12th, 2024. I think that will be way too much, but we have some greens there. Okay, what we are going to do now, we are just going to focus on the green, the red, and the black, right? Now, you see for March, that was last month, the previous was 0.3%. The forecaster said the news is going to come out at 0.2%, and the news actually came out at 0.2%, which means the forecasters were right. This is what I was telling you guys. Like, these guys are always kind of telling where these things or the result how it's going to be, right? So this one, the actual is the same as the forecast, which you don't expect any effect on this one. There is no effect. Is as expected. The forecasters expected the release to come out at 0.2%, and the actual came out 0.2%. So the market is not going to buy impulsively, it's not going to sell impulsively, it's just going to continue the way it was moving. There is always no volatility at this kind of result. With this kind of result, there's always no good volatility in the market. And February was the same thing. Forecasters were forecasting it to come out at 0.3%, and it actually came out at 0.3%. Now let's look at the two red we have here, which was January and October, right? Now you see in October, the previous was 0.2%, and the forecasters forecasted it to be 0.3%, and the news came out to be lesser than they were expecting. That's why we say actual greater than forecast is good for a currency, meaning that actual lesser than forecast is bad for currency. Now if you see the actual 0.2% is lesser than the forecast, which is 0.3%. So let's look at the green. Now for the green, the previous was at 0.2%. Forecasters forecasted it to be 0.3%, which means they still forecasted it to be better than the previous, and the actual, which is the result, came out to be 0.4%. If you look, you see that when you look at the forecast kind of tells what the result might come out to be. And if you look at it very well, you see that it actually comes out mostly as it was forecast, but not all the time. But most of the time, they will give you some signs, some direction. You understand? They were expecting it to be 0.3%, which is still better than the previous, which was 0.2%. And it came out to be 0.4%, which is positive for the dollar. When it comes out, lesser, negative for the dollar. So whenever you want to trade CPI, what you just have to do is to come here, analyze the previous, the forecast, and then from the forecast, you might likely see what the outcome of the news might come out to be. You understand? So remember, if it is positive, which is green, the currency US dollar is going to buy impulsively, and if it comes out negative, it is bad for the currency and dollar is going to sell impulsively. So this is just how you use your Forex Factory to analyze CPI and know the direction you will be trading. This is how I used to do it. After I've looked into an economy, just the way I have directed you guys to do, right? What I do is I come here just before the news is being released, and I will look at what the forecasters are forecasting. If the forecasters are forecasting it to be positive and myself I was expecting it to be positive, then I'm going to buy. I'm going to buy even before the news is being released. You understand? Because once the news comes out, the market impulsively shoots to the upside if it is positive. Then if I look at the forecast, and then the forecast is saying that the news is going to be negative, and myself I was expecting the news to be negative. After my research and everything, I'm going to sell before the news is being released because of the impulsive movement. Then if the forecasters are forecasting something totally different from what I was looking at, guys, what I'm going to do is very simple. I'm just going to wait for the news to come out. Once the news comes out, it will shoot impulsively to the upside or shoot impulsively to the downside. And when it starts to correct, that's when I will sell. So if it buys impulsively and I'm not in the buy, at some point it's going to leave what we call an imbalance, and that imbalance will later at some point be refilled. So what do I mean? What I simply mean is this: there's always a correction in the market. After that impulsive buy, the market will simply come down. And if it sells impulsively, the market at some point will correct itself back up. I hope this videos gives you guys a lot of value, and I hope you guys enjoyed this video. I'll see you guys again in my next video, and in that video I will be talking about GDP growth. So make sure you subscribe, like, and turn on the notification bell. Alright guys, so this is where we'll be calling it a wrap on this particular video about inflation. If you found value in this video, make sure to like, subscribe, and turn on the notification bell for more videos like this will be coming your way, guys. I'm coming up with a lot of fundamental videos, and it is only when you turn on the notification bell that the next video will be able to get to you. Make sure to check the links in my description. The links in my description there can actually help your trading. I have a link there that takes you straight to my Telegram community. My Telegram community is totally free. I send signals, I hold classes, and I teach people totally for free in my Telegram community. We trade every day for free. Make sure to use the link in my description and sign and join my Telegram community. It's totally free for all traders. And make sure to use the link in my description to sign up with Access Market. Access Market is the best broker, and you should be trading with Access Market. Also, there's a link to my website where you can actually reach out to me if there is anything you want to inform me about. You want to join my mentorship, you want to join my VVIP Discord community, whatsoever. I have a website there in my description. Do well to check it out. Thank you so much, guys. I will see you guys again in my next video. Peace out.